Hello and welcome. I'm very pleased to welcome two guests today to talk about CryptoCompare's new Bitcoin Volatility Index. We have with us James Harris, Commercial Director at CryptoCompare, and Carol Alexander, who's Professor of Finance at the University of Sussex Business School, amongst a few other roles. Welcome, guys. Thanks for joining us. Carol, perhaps you could start out just introducing yourself and a little bit more about your background.
Yes, Paul. So I've been at the University of Sussex most of my life and returned in 2013. Having been in the industry and various other universities, I've been consulting, sort of designing models like an architect, for exchanges, for banks, for software companies, and I'm also the visiting Professor of Finance at Peking University, Oxford campus, and co-editor of the Journal of Banking and Finance.
Thank you. And James, what about you?
So hi, Paul. Really nice to be on. I'm a long-time listener, first-time caller, so to speak. And so my background is in investment banking, hedge fund management, and moved into digital assets in 2017. Really pleased to join CryptoCompare at the beginning of this year. CryptoCompare is a leading digital asset market data provider, which caters to retail, corporate, and government customers.
Great, thank you. So we've seen a lot of activity, obviously, in the last year, especially a lot of more institutional interest in the crypto markets, seeing significant growth in the derivatives markets. And as this market's maturing, much like markets throughout history, new instruments have kind of have materialized, and you've worked together on producing a Bitcoin volatility index, and volatility indexes kind of widespread in other markets. So how did this collaboration come about, Carol?
I'm trying to remember when I first met Charlie Hayter. It was, I think, about 2.5 years ago. I was just getting into Bitcoin, developing modules that I teach on blockchain and crypto, and I was also on my LinkedIn site making some posts, and Charlie, I think, contacted me, and then I went up to meet him in the London offices and met Vlad and Alyssa, and it was before James started, actually, and I suggested that we collaborate, and I designed some models when the opportunity arose.
Great. And James, on your side, how's this sort of come about to get to this point? I mean, obviously data is your thing. Data is the heart of all of this, to be able to produce these things. What were you seeing on the demand side to sort of drive you to bring this to market?
Well, I'm really thrilled that we've been able to do this with Carol and her team. I think one of the first things I wanted to do when I first came into CryptoCompare was to offer a volatility index, initially perhaps only as an informational point only. Because really, I believe that it's a very important point of information that the market can use to assess fear and greed and risk, and certainly, its traditional counterpart is used in that way. And I felt it was a missing component in the market infrastructure. So that was really it. As we had more conversations as the space institutionalizes, and we see that a lot because our clients are increasingly institutional, they're beginning to ask for such products and metrics. So that's really the genesis of it, an absolute stroke of luck to have the conversation with Carol back in March this year, the last conference before we locked down, about such a product, and thrilled that she had the time and interest to do it with us.
Yeah, great. And I guess as we'll come on to, reliable sources of data to be able to construct these models are essential. And over the years, I guess, it would have been too soon 3 or 4 years ago, because maybe the infrastructure wasn't there, but firms such as CryptoCompare have obviously addressed that problem very well more recently. So maybe, Carol, just for some of our viewers that might not even be familiar with the terms, could you just kind of briefly summarize, in essence, what a volatility index is, and maybe how they came about in other markets by comparison?
In a minute, I'm going to ask you to say generalized autoregressive conditional heteroscedasticity 4 times.
Not today.
That was in my interview. So,
but it's not that sort of volatility. That's a statistical volatility that you can measure on the underlying. Okay, and that's easy to get the data. You can, as long as it's relatively high frequency. But this is an implied volatility index. So you need options data, and you need sufficient liquidity in the options market for a reasonable spread of strikes for this type of volatility index. This is what's used by the CBOE for their VIX index for the S&P. And it's basically representing the average volatility that options traders believe will happen over the next 30 days, if it's a 30-day. I mean, there's a whole family of them. You could have a 10-day or 20-day or 1 day or whatever, you know. But so it's an average view of option traders, these being perhaps the most informed traders. That's what it is. It's just an index of the option traders' view of what volatility will be over the next 30 days or whatever.
Sure. And James, I mean, I guess the options markets have been a more recent phenomenon in crypto. You know, over the last few years, we've seen the emergence of various derivatives products, but options are definitely more recent. I guess Deribit is one of the leading, I guess, exchanges in the less regulated world, but also CME have launched their options products earlier in the year as well. So how is that market growing? And to Carol's point about having, you know, needing these robust reference points, what is liquidity like in the options markets now?
Well, liquidity is increasing. You're right about Deribit. They're a key player in the space, and I think that they saw that there was I wouldn't call it a niche because that would be disrespectful to the size of the market, but they saw that there was a suite of products that were lacking, and they've approached that gap with gusto, and they have currently around 70% of volumes and open interest. And so certainly that's where you can go if you wanted to get a good sort of idea of what the options market is. But you're right. I mean, you know, this is an industry that's really started from by having, you know, leveraged instruments on digital asset exchanges. So, you know, BitMEX was the big futures innovator, and, you know, solving that margining problem was the key thing that they did. And then, of course, from there, you then start being able to offer more and more complex products. I mean, options in themselves are not the easiest things to get your head around, and that's why Carol talks about the savviest investors to trade options, because that's where, you know, they can express their views most correctly. But, you know, the sector needs such products, especially as institutions come in. They can use options to express very specific views and hedge themselves very specifically, dependent on what their book looks like, as opposed to, you know, the retail crowd looks a little bit like, okay, well, how do I make 10x out of this? And so that's a different value proposition. But the role that we play, you know, we're a market data provider, and we collect the data from these exchanges, and we try and make it uniform, and we think we've got a good idea of what the space looks like. So we were able to accompany Carol on this journey of creating this product. My team, led by Quinn, and Carol herself was ably assisted by Arbin, played critical roles in developing this. I was mainly on these calls trying to understand what Carol was talking about, whereas the team behind me, Quinn and Jimena, were instrumental in creating this, and their hard work is duly rewarded here.
Yeah, absolutely. And just to be clear, I mean, this is specifically an index. It's not a tradable instrument in its own right. The expectation is that over time, exchanges, other market participants would use this as a reference point to create tradable instruments themselves. So that's not something that CryptoCompare, or you, Carol, in particular, are looking to do yourselves. So, and you said, like, you know, options trading is especially by comparison with the spot markets and the vanilla derivatives markets and futures contracts is more complex. But I guess people, options traders up until this point could basically synthetically manage kind of the volatility risk using various option strategies directly.
Yeah, well, no, they don't work. You can't trade volatility directly on a straddle because A, it's expensive, and B, it becomes a directional trade as soon as the price moves.
Yeah, so that's kind of on one end. One step beyond that, I guess, more recently, certain brokers in the space have been offering variance swaps as OTC.
Yeah, on chain, over the counter.
And over the counter products. Could you maybe explain what they are and how they're kind of a step towards what you might be getting to here?
Well, it's just a trade-off between the physical and the implied volatility. So as I mentioned earlier, GARCH is a physical volatility, but a realized volatility is a very simple, equally weighted. It's just a sum of squared log returns. It can be anything. It's just in the terms and condition of the contract, but it's a floating leg. You define it as you want. And then you've got a fixed strike swap rate, right? And that swap rate is depending on supply and demand in the market. The brokers will just make their own swap rate, whatever they think they can charge. So it's just like a fixed or floating swap on some notional. But to get a fair value for that swap rate, you need to use a sort of options replication strategy where you trade options that are out of the money, either side of some separation strike, and each option is weighted by the inverse of the square of its strike. And that gives you the fair value of a variance swap. And it's fine, that's good. The only thing is that the low strikes inverse of the square of the strike means that you have a higher weight on the low strike options. In other words, the deep out of the money puts. And those are the options which tend to be the ones that trade most when there's fear, because it's like an insurance strategy. If you think there's going to be a crash, you're going to buy an out of the money put. Mm-hmm. So those very sensitive options are really instrumental in the value of this index. And one of the reasons why to make it live stream every 15 seconds, we've used that formula with various adjustments that are described in the methodology document in terms of liquidity for the strike range. But also we need to be very careful about what happens at particularly the last hour of the day, because the move contract underlying is a time-weighted average price over the last hour of lots of 10 different spot exchanges. And they probably are, people trading them, the move contract, are probably hedging using options. And so because the move contracts are settled in that last hour of the day, we find that at that point, we have to filter the BVIX quite carefully, because of the sort of manipulation that's not manipulation, maybe just out of the money put pressure that's going on there.
Yeah, and talking about that move contract, this is in reference to FTX, the derivatives exchange. So that's
not actually an options contract. It has the payoff that's the same as a straddle, but it's just defined on the underlying, just a time-weighted average over different hours. So if you take a 1-day move, you're going to trade a time-weighted average from 0 to 1 UTC versus a time-weighted average of 23 to midnight UTC. Or it can be over a week, but it's always that first hour and last hour absolute difference. So it's just an underlying thing. It's just if you want to hedge it, that's when you might have to use options. But it's all very approximate because the settlement is over 10 exchanges, and it's not exactly a straddle, because as I mentioned before, it's not exactly a volatility trade. Anyway.
Sure. No, absolutely. Very interesting. And James, I guess to that point, we mentioned that for this index, that Deribit is the main point of reference. But things like manipulation risk that Carol just described there as well are obviously critical in terms of building trust and confidence over time. Where else did you look in the market? Because we mentioned that CME list options contracts for Bitcoin and exchanges like OKX as well. Why did you specifically choose to go with Deribit? And are there plans to kind of include other reference points in the future?
Yeah, we went with Deribit, as I mentioned, because it's a good representation of the entire market. They've got 70% of the volume in open interests, as I mentioned earlier. I think it's important to note that if you wanted to create an index, a volatility index, then you're probably going to have a volatility index for each particular venue, because effectively we're talking about non-fungible instruments that are unique to those platforms. And so, even if you've got the exact same contract specification across two exchanges, they will trade at different prices. Now, we could, of course, look at aggregation, but realistically, what we'd be doing here is we'd help each exchange partner create an investable index stroke instrument. So there'd be one for Deribit, there'd be one for OKX, there'd be one for CME. And of course, that's one of our main motivations for rolling out this product in this way, so that people can understand this is what it looks like. And, that we can then hopefully have such conversations. And in fact, actually, maybe it's interesting for Carol to point this out, but there is a risk in not a single venue risk, but the reverse. But perhaps I hand that one over.
Oh yes, about settlement prices.
Yes, indeed.
Yes, it's quite important, I think, in designing a futures contract to ensure that settlement prices are manipulation proof. In fact, it's well known, there's a paper in the Journal of Finance, the top finance journal, written by a pair called Griffin and Shams. They also published a paper in the Journal of Finance about tether flows and the connection between tether and Bitcoin, on-chain flows. So, I mean, this is a very well-respected pair from the University of Texas, and they proved that what was happening with the ordinary VIX futures, that's the S&P 500 VIX futures, was that there were manipulative trades on the CBOE options. But Move, for example, by having a time-weighted average price, that removes the, well, at least it reduces the ability to manipulate settlement prices. Mm-hmm. On the other hand, when you have an underlying that is a reference rate across many exchanges, for example, like the CME futures, but the CME have problems anyway because they're not traded 24/7. So, you know, you can't trade as fluidly as you can on the other cryptos. But anyway, this time-weighted average is a nice way to settle, but you do need the one reference in order to hedge it properly and to make sure that it's manipulation proof, which is why James said, you know, anybody can define the settlement prices as they want in their terms and conditions, and they don't need to be the same, even though it's the underlying VIX index that, or VIX type index that they use is the same.
Sure. Maybe we just step back a little bit, because I'm assuming this didn't come about in the last week or two. There's some work gone into this. Carol, can you just maybe kind of enlighten us a little bit more on kind of the research that you did to get to this point, and then the methodology that you used to come to the final, create the final index that you have?
Okay, well, I'll be as brief as I can because it's quite a long story.
A summary, a high-level summary of it.
All my research, almost all my research is with my PhD students. I mean, I have just recently started doing research with grown-ups, but I mean, it really starts, you know, the implied volatility space starts with Stamatis Leontinis and Dimitris Korovilas, who were PhD students when I was at the University of Reading. And Stamatis worked on the VIX type indices for the FTSE and other, before they were quoted. So, you know, we replicated for other markets. Also, we looked at skewness and kurtosis indices, because volatility is just the first moment, you know, in a distribution. There's the variance square root is volatility. Then there's skewness. So we also have these indices. And then Dimitris talked about what worked on the exchange traded products with me. We have lots of papers with these students you can look at in my profile. So exchange traded products, and they were really, really interesting for individual investors, because of course futures contracts in general are too big for ordinary people. But as soon as you get direct trades on volatility to ordinary investors, particularly when they are 4 times leveraged, or, you know, and then you can trade the curve on the, but people didn't understand about this roll yield for replicating a constant maturity. There's always a roll yield when the backwardation or contango in the futures curve. So I got involved in lots of, you know, expert witness type, well, I didn't actually go to court or whatever, but, you know, helping people with the sort of terms and conditions that they signed into. Anyway, so then also Johannes Rauch, we did a lot of work on the variance risk premium, the skewness risk premium, kurtosis risk premium, are they different, and this sort of thing, but still all in the S&P 500 space. And then I started working with 2 very bright young MSc students in Germany, Arben Immerai. So he's the one that his master's thesis was replicating, doing the Bitcoin VIX, and Daniel Heck. They're both my first year PhDs now, and Daniel's working on price discovery. So actually quite a lot of the work that I've been talking about has been on which market leads. And it also helps us know, you know, should we really be looking at, for example, OKEX or Huobi, you know, which market is the first mover? One of the reasons why in Deribit, we chose Deribit, is that it's not just the volume, but it's to do with how much how much speculative trading goes on there, or at least how quickly the contracts are, you know, it's not just volume, it's open interest as well. It's the relationship between those that determines the importance of the product. Anyway, so yeah, I mean, you better stop me, otherwise I could just carry on talking for a
No, that is great, thank you. I know we're relatively short on time here, so James, maybe looking forward now, how do you see you know, this rolling out from here? How have your conversations been going with different exchanges and other market participants that you think would have gain most value from this? And how far are we from kind of more futures contracts which reference this index coming to market?
Yeah, I mean, it's look, it's a very exciting time. So our rollout strategy was first to provide this information point, as we discussed before, so that people could understand what this looks like and have a methodology that they can lean against. And really, what we expect now to happen is that if you look at the pathway of products and the way they evolve from CBOE's index, is that we probably start with our information point, and then at some point you'd have a family of investable indices, and then you'd have a futures product which would reference some methodology that's been created, and then ultimately there'll be a host of ETPs and ETFs that then invest in the futures themselves and create products like that, and that's how the ecosystem will probably be seeded. Now we're obviously at phase 1 there, and my hope, our intentions at CryptoCompare for going live with this is to solicit conversations with exchange partners, asset manager partners. The investable indices side, we have our partners MBIS standing by, who will be able to provide assistance, so that it would be institutional grade and regulation proof. And so really, this is a come and get me type conversation, whereby, you know, people who are interested in this methodology and would like to have something on their exchange or platform, we're here to help.
Great, and then just a step beyond that, I guess, you know, people would be looking at some of the other assets on the leaderboard. Ethereum, I guess, being the obvious one as the next most liquid asset, but still some way behind in terms of liquidity and depth in these order books on these exchanges. Do you see the benchmark that you've kind of set here for the level of volatility, the depth in the order books for Bitcoin really being that benchmark for bringing in other assets? So would you assume that Ethereum really needs to get to where we are now with Bitcoin before we could look to doing similar for Ethereum?
Yes, I mean, effectively what we're talking about here is that the Bitcoin market structure is just more advanced. And so Ethereum's a little behind. And also, I haven't run the numbers on this, but I suspect that if we were to create something on Ethereum right now, it would be actually quite highly correlated to Bitcoin. But I think that as we see a divergence between the narratives and the use cases for, say, Bitcoin versus Ethereum, Bitcoin being a monetary asset, perhaps Ethereum being a decentralized computer that earns rent of the applications built on top, then with time, I'd expect, as the Ethereum market infrastructure, market structure approaches that of Bitcoin, we will see divergence in the performance of the two, because they're very different things. And so it's certainly something that we would look to add. At the moment, we'd like to focus on the Bitcoin variance and then see where that ride takes us. But if anything we've done in the last 2 years has told us, that it's going to be a very interesting ride indeed.
Absolutely, absolutely. Well, look, all very interesting stuff, and I think a really important milestone for the market in general. So I'm really looking forward to seeing how this all pans out from here, and what instruments we do see coming to the market in the near future. Thank you both for joining us today. Very much appreciated, and we hope to have you back on soon to discuss similar topics.
Thank you so much for having me, Paul. Thank you.
Thank you.